Hey everyone, in my last episode, I talked to you about the SEP IRA, which has some incredible tax benefits like being able to deduct up to $58,000 on your taxes and putting that money to fund your retirement. Well, today's episode is all about the solo 401k, which allows you to do the same exact thing and more. Welcome back to the channel, everyone. My name is Sherman, a CPA here at Life Accounting, where we help you save on taxes and boost profits in your business. Today, I want to help you do this by taking advantage of solo 401ks. By the end of this episode, I want you to know everything about it so you can start reaping the tax benefits and taking advantage of compound interest. By the way, if you're new to our channel, then go ahead and subscribe so you don't miss out on any of our future episodes that can help you manage money in your business. With that said, let's discuss the solo 401k. All right, so what is the solo 401k? The solo 401k is just a one participant 401k plan. Traditionally, 401k plans are offered by an employer to its employees to help them save for retirement. But a solo 401k just applies to one person who just so happens to wear both hats, the business owner and the employee. So basically, if you are self-employed with no employees, then the solo 401k was designed for you. Because you are the employer and the employee in your business, you get to reap the tax benefits of both sides. As of 2021, you can contribute up to $58,000 into a solo 401k account. For comparison, that's $52,000 more than you can take in a traditional IRA or retirement account. Normally, you can only contribute up to $6,000 per year in a traditional IRA. To make this even better, you can deduct your contributions from your tax return. So for example, if your taxable income is $200,000 with an effective tax rate of, let's say, 25%, then you'd owe $50,000 in taxes. But if you contributed $50,000 to your solo 401k, then your contribution would lower your taxable income to just $150,000. This means that instead of paying $50,000 in taxes, you'd only pay $37,500 in taxes, which is 25% of $150,000. Not to mention the fact that you will be putting the $50,000 you contributed into an investment vehicle that will compound over time to be worth much more in the future. All right, so that's what a solo 401k is, a retirement plan that allows self-employed individuals to take advantage of both employer and employee contributions into a retirement account. Now, with that being said, let's look at the pros and cons of a solo 401k plan. Let's start with the pros. All right, number one, tax benefits. In my opinion, there is no other retirement plan that has more tax advantages than a solo 401k. The contribution limit is so high that it's hard to avoid. Number two, you can borrow money from your solo 401k. You can borrow up to $50,000 or 50% of your solo 401k plan value, or whichever is less. And guess what? There are no penalties for doing this. There are no tax fees or penalties associated with taking out this loan. However, you may have to pay interest on that loan. Number three, you can make Roth contributions. Sometimes it may make sense to use after-tax dollars to contribute to your retirement. For example, you might choose to make Roth contributions if you think that your tax rate in the future is going to be higher than what it is today. Or maybe you think that your income will be higher in the future, which will put you in a higher tax bracket, so you may want to take advantage of a smaller tax bracket today. But even if you do nothing with this option, just knowing that Roth contributions is a feature associated with solo 401ks is a huge benefit. All right, so those are the top 3 pros of a solo 401k in my opinion. Now let's look at some of the cons. Con number one, more administration. Solo 401ks are a little bit more complicated to set up than other retirement accounts. As you can imagine, with all the things you can do with it, it makes sense that it is more complicated to set up. You will likely need to go through a firm to set up your solo 401k. Number two, more fees. Because of the additional administrative work, there are more fees associated with a solo 401k account. You might encounter administrative fees, investment fees, legal fees, and more. But of course, fees will vary based on who you choose to do business with. And that's really it as it relates to the cons of the solo 401k. In my opinion, the tax benefits of the contributions and the flexibilities to take advantage of Roth contributions or to take out loans when you need money really outweigh the cons here. So let's talk about some of the eligibility requirements, and then we'll talk about how this compares to a SEP IRA. To qualify for the solo 401k plan, you must be self-employed and generate some form of self-employment income. So basically, you can't just create a business and use money from your job or another business to fund your solo 401k account. No, you must actually generate income from your business, which is used to fund your solo 401k plan. You also must not have any full-time employees involved in your business. The solo 401k, again, is designed for one participant businesses. Therefore, if and when you hire employees, you will need to offer a different 401k plan that applies to yourself and all of your employees. However, there is an exception to this rule. If you have business partners involved in your business, then they are not considered full-time employees. Also, if your spouse works with you in the business, then she is also not considered a full-time employee for purposes of the solo 401k plan. So basically, as long as you meet those requirements, then you're set. Now, the next thing you need to know is how contributions work with a solo 401k. Contributions into a solo 401k works in two ways. Remember, you can contribute as both an employee and as an employer. So as an employee, you can make what is called elective deferrals. You can contribute up to 100% of your earned income up to $19,500. Then as an employer, you can make additional contributions based on the total compensation. According to the IRS, you can contribute up to 25% of compensation as defined by your solo 401k plan. So here's a simple example to illustrate this. Let's say you made $100,000 in earned income. Right off the bat, you can contribute $19,500 of your earnings into your solo 401k account. Then you can contribute up to 25% of the $100,000 in earnings into your account as the employer, which would be an additional $25,000. That will be about $44,500 contributed into your solo 401k plan and also deducted from your taxable income when tax time comes. How does that sound to you? Let me know in the comments below. Last thing here, how does the solo 401k compare to the SEP IRA? There are a few things you need to know about how a solo 401k compares to a SEP IRA. Number one, the SEP IRA has more simplicity. SEP IRAs are very easy and simple to set up. This is the one and only reason I would choose a SEP IRA over a solo 401k. If you want the fastest and easiest way to invest into your retirement, then a SEP IRA may be best for you. Number two, the solo 401k contribution limits are easier to take advantage of. While the total contribution limit is roughly the same with a SEP IRA and solo 401k of $58,000, the contributions are much easier to take under a solo 401k. This is because the SEP IRA does not allow the elective deferral of up to $19,500. You're limited to about 20 to 25% of your total compensation in a SEP IRA, while the solo 401k gives you that plus another deferral of up to $19,500. In other words, in order to take full advantage of the $58,000 contribution in a SEP IRA, you'd have to be making over $200,000. While on the other hand, you can make less than this and max your contribution in a solo 401k plan. All right, number 3, the solo 401k has more flexibility. The things we talked about earlier, like the ability to take loans from your account or the ability to do Roth contributions, are just simply not possible under a SEP IRA, while it is possible to do this with a solo 401k. So although a SEP IRA is easier to set up, it provides much less than a solo 401k when it comes to features. Ultimately, if you're interested in saving more money on your tax bill while putting more money towards your retirement, a solo 401k can be a great tool to use. But let me know what you think is best in the comments below. And if you enjoyed this video, please let me know by clicking the like button below as well. Thanks for watching, and I'll see you in the next episode.